Hello, everyone. I'm Chris Kapches, CEO of Chestnut Park Real Estate, and today I'm very happy to be presenting to you the October market report for Toronto and region. And there's going to be no surprise in terms of what I'm going to be telling you about the resale market, because any of you that have been following what we've been talking about during the course of the year will see that the data that comes out of the October marketplace is a continuation of what's been happening from literally from the beginning of the year, from January, when macroeconomic issues, primarily stemming from the tariff threats, have really changed the real estate landscape as well as the economic landscape in Canada, and particularly Southern Ontario. But here we're focused on the real estate market. And the best way to describe it is the market continues to correct. And what I mean by that is you'll see in the data on the screen a number of items related to the overall market on a year-over-year basis. But there's two areas that I'd like to focus on today that I think speak to the correction of the marketplace. The first one is the total number of active listings, the inventory that's available out there to buyers. In October, we finished the month with 27,808 active listings. That is a record for any October since record keeping, primarily by the Toronto Real Estate Board, since record keeping has started in this category. I should point out, though, that isn't as high as what we've already seen this year. In May, June, and July, we had over 30,000 active listings. But for this time of the year, this is a huge number of listings, because historically, as we move to the holiday season, and yes, we're almost there at the holiday season, the total number of active listings begins to decline as people start focusing on other matters other than the sale of their property. So 27,808 properties available for buyers. So buyers have lots of choice, they have lots of time, and they have lots of flexibility to negotiate with sellers. Some sellers have been quite reluctant to reduce their prices, but buyers are really in the driver's seat right now. As a result of that, the second factor that we see is the average sale price. You can see the average sale price came in at $1,054,000. And that includes all condominium apartments. And I'll get into that a little later in this presentation. But that is a decline of over 7% compared to October of last year. And again, anyone that's been following the market through these reports over the course of 2025 will know that there has been a consistent decline in the average sale price on a year-over-year basis. So we see this huge amount of choice that buyers have, and that huge amount of choice is driving the average sale price down to the point where we're starting to approach the $1 million mark. Long way from where we were during COVID, when we had an average sale price in the first quarter of 2022 of $1,322,000. But it has come down to obviously a more reasonable level at $1,054,000. All predictions are that that number is going to continue to decline, marginally, but continue to decline as we move to the tail end of 2025 and then into 2026. So those are the two factors that are driving the overall market, is the huge amount of inventory, which is giving buyers choice. As I said, buyers have flexibility, they have time to negotiate, and they're driving the average sale price down. Now, that's the overall market. Contained inside the market are some micro aspects that I think need to be discussed. First of all, the condominium apartment market. It continues to suffer, notwithstanding that it's reached some pretty reasonable levels in terms of average sale price. It is continuing to suffer. For example, In the 905, the average sale price for all condominium apartments sold is $574,000. Notwithstanding that affordability is still a dominant factor in the marketplace, that's a number that you think would drive sales. But unfortunately, sales were down in the 905 by over 10%. So prices have come down, but sales are still not responding to those low prices. Similarly, in the 416, the average sale price for condominium apartments is now down to $699,000, and sales are down on a year-over-year basis by almost 3%. So that sector is suffering, but it's suffering because it's got, for lack of a better expression, some kind of historical structural issues. And what I mean by that is the bulk of the properties that are available, the condominium apartments, unfortunately were developed for investors and not for end users, particularly families. So notwithstanding that they're getting to a price point that makes them affordable in the context of the overall market, they're still not attractive to buyers because they can't be used in a way that allows them to develop families, to enjoy them as families, to enjoy them as end users. Having said that, if we look at detached and semi-detached properties, particularly in the 416, their numbers remain relatively lofty. For example, detached properties in the 416 in the city of Toronto came in at a little over 1.6 million. And if we look at semi-detached properties, they came in at a little over 1.2 million. So clearly the consumer is still looking to those properties to satisfy their housing needs. If we were to look at, for example, semi-detached properties in the West End and in the East End, particularly close to the central core, we see that in fact in those areas, semi-detached properties are actually selling for greater than their list prices in very short period of time, like 15 days, 14 days, depending on the area. The hottest neighborhoods continue to be Leslieville, Riverdale, and the Beach in the East End, where they're sought-after neighborhoods. Even though they're relatively pricey compared to the overall market, they offer the consumer a lifestyle, a community that still attracts them. So what we see is we still see that there is demand for an appropriate type of property, but that demand is now there because price points have come down. So even those numbers that I mentioned are numbers that are actually lower than they were a year ago. And I think that is going to be the pattern as we move towards the end of the year and then into 2026. The forecast for 2026, which I'll get to when we do the November reports, and then particularly when we do the December report looking ahead into 2026. At this current time, they're looking for no growth in terms of the number of sales of properties in 2026, but potentially a 4 to 6% decline in the average sale price. But as we move through 2026, the confluence of lower average sale prices with lower borrowing costs, I think will be the springboard for a very robust market as we get to the end of 2026 and then move into 2027. But we don't want to get ahead of ourselves, and I'll save a more detailed analysis of that in future reports. But for now, that's where the market stands, and I look forward to getting the November data so that I can present it to you. Thank you very much.